So maybe I'll take it from two different investor perspectives. So I think one is maybe global investors who have a lot of exposure to, I think, US and Europe. They are now looking at Asian private credit in a much more positive way than they've done before. And what's really driving them are two things. One is, I think, the relative value that they see in Asia private credit. I think they're seeing about 300, 350, 400 basis points premium to what they're getting in their own home markets. So that's obviously a driver. And second is just the diversification. I think they're just too heavy in US and Europe, and given the kind of real economic growth rate that we are seeing in this part of the world, I think the investors, the larger investors, are realizing that it does make sense to put in some money on the Asia side as well. So that's really driving as far as the global investors are concerned, and that's a great development from our side, because that brings in sophisticated capital, that brings in nuanced strategies that we can look at. And I think the other aspect would be really, I think, investors who have been investing in the public markets, more so in Asia. I think what we would say is maybe, and again, that's really where the topic is, whether you should go to private or public debt. I think the advantages of private debt are clearly, we get a lot more tighter security than what we see on the public market side. We have far tighter covenants, far tighter cash flow ring fencing than what you would see on the public side. And again, I think something very peculiar to Asian public markets. I think most of the public issuances are concentrated in a few sectors, whether it is real estate, whether it is natural resources, whether it is mining services, renewable energy. I think that would probably take more than 90% of the overall issuances in Asia Pac. Private debt is a lot more diversified in terms of sectors. So you definitely get exposure across sectors, and you're really not very heavy in 3 or 4 sectors. Obviously, the downside to private debt is the illiquidity. So if you have money that you can park for, I think, 5 to 7 years time frame, we definitely think private debt is something interesting. You get paid for illiquidity premium, you get tighter downside protection, and you get better diversified portfolio.